What information must be collected and reported? This is where transparency becomes personal. In Section 3.1, you learned who qualifies as a beneficial owner. Now we address the question that investors will immediately ask the moment this issue surfaces in escrow. What exactly does the government want? The 2026 Real Estate Reporting Rule requires the collection and submission of specific identifying information about the beneficial owners of a covered legal entity purchasing residential real estate without federally regulated institutional financing. This is not general business data. This is personal identifying information tied to real human individuals. That reality changes the tone of the conversation. Professionalism and clarity become critical. Core information required. While final federal forms will control the exact reporting format, beneficial ownership reporting generally includes the individual's full legal name, date of birth, current residential street address, identification number from an acceptable government-issued document, and in certain reporting contexts, an image or copy of the identification document. The report also identifies the individual's ownership percentage or describes the nature of their substantial control. Acceptable identification typically includes a United States passport, a state-issued driver's license, or another government-issued identification document. These standards closely resemble the identity verification procedures used by banks under the Bank Secrecy Act, 31 U.S.C., paragraph 5311, SEQ. This is not a casual data request. It is structured federal financial transparency reporting. Why this level of detail is required? Under 31 U.S.C., paragraph 5336, commonly referred to as the Corporate Transparency Act and related FinCEN regulations, Congress determined that anonymous shell ownership created vulnerabilities in the U.S. financial system. The objective of beneficial ownership reporting is to eliminate anonymous entity ownership in certain high-risk transactions, identify the ultimate human beneficiaries behind legal entities, and prevent concealment through layered ownership structures. The federal government is not requesting this information for marketing purposes, taxation analysis, or public disclosure. It is seeking to close reporting gaps that historically allowed anonymity in residential real estate purchases involving legal entities. Transparency is the policy objective. Arizona investor. Reaction. What to expect. Arizona has a strong investor culture, and many investors intentionally form LLCs for privacy, liability protection, and asset segregation. When this issue arises, agents may hear immediate resistance. Clients may say, "I already filed beneficial ownership information under the Corporate Transparency Act." Others may say, "This is private information." Some may add, "I formed an LLC specifically for privacy," or ask, "Is this going to become public record?" Agents must respond calmly and accurately. The correct professional approach is, "This is a federal reporting requirement applicable to certain residential real estate transactions. The information is submitted directly to FinCEN and is not recorded in county property records." That distinction is important. The information is not part of MLS data. It is not recorded with the county recorder. It is not published online. It is submitted to a federal financial intelligence agency within a secure reporting system. Clear explanation reduces emotional resistance. What agents must not do. Arizona licensees must exercise caution in these conversations. Agents must not provide legal advice about restructuring ownership to avoid reporting. They must not suggest splitting ownership percentages to remain below thresholds. They must not recommend delaying closing to avoid applicability. They must not misrepresent the purpose or scope of the rule. Under ARS, paragraph 32-2153A. 1. Dishonest dealings may result in discipline. Under AAC, R4-228-1101A, licensees must exercise reasonable skill and care. Even casually suggesting avoidance strategies could expose a licensee to regulatory risk. Neutral compliance is the safest and most professional approach. Data security and professional role. Clients will understandably ask about security. FinCEN maintains secure federal databases similar to those used for anti-money laundering enforcement and financial intelligence reporting. However, agents should never guarantee data security or make promises about federal systems. You are not the custodian of the report. In most transactions, the settlement agent or title company will file the real estate report. Your role is awareness, coordination, and professional communication, not submission of the report itself. Understanding your role prevents overstepping. Coordination with escrow and title. In covered transactions, the settlement agent or title company will typically handle reporting mechanics. Agents should inform escrow early if the buyer is purchasing through a legal entity and confirm whether financing is institutional or private. Early coordination prevents last-minute stress at closing. When beneficial ownership disclosure is raised 2 days before funding, anxiety increases. When it is anticipated early, it becomes a procedural step rather than a crisis. Proactive awareness reduces friction. Privacy versus transparency, the cultural shift. Many Arizona investors formed LLCs to protect liability and maintain privacy. The 2026 rule does not eliminate liability protection. It does not remove tax advantages. It does not prohibit entity ownership. What it changes is anonymity in certain covered transactions. LLCs continue to provide liability shielding, asset segregation, and structural flexibility. However, they no longer provide complete transactional anonymity when purchasing covered residential property without institutional financing. That is the cultural shift. Transition to Section 3.3. You now understand who qualifies as a beneficial owner and what information must be collected. The next logical question many investors will raise is how this differs from the Corporate Transparency Act. Section 3.3 will clarify the distinction between formation-based reporting under federal law and transaction-based reporting at closing. Understanding that difference will eliminate confusion and strengthen your ability to guide clients professionally.